Well, hello again, everyone, and welcome to the Options Mentor. And wow, did we have a week with big news that on the inflation front, we had the CPI on Thursday, the PPI, which was a little bit more of a non-event, I think, on Friday. But that CPI did come in a little bit hotter than the market would have liked. Of course, a hotter number means inflation was a little higher, and they didn't care for that. So Thursday, we went down pretty good. And then Friday, the PPI came in a little weaker, so they decided to key off of that. And now, by the end of the day, Friday, I'm reading they're back to expecting get that, 7 rate cuts in 2024 this year. I just don't see it happening. In fact, the Fed's pretty much already pushing back on it being March. I think you might see something mid-year, but I don't see 7 of them happening. I think the market's getting a little ahead of itself, which it often does anyway. Now, the week ahead, of course, tomorrow we're closed. Tomorrow being Monday, Martin Luther King's birthday, the market will be closed. And then we'll resume Tuesday through Friday, of course. And what we have there is a lot of Fed speakers talking. I didn't see the chairman anywhere speaking, Powell. But a lot of Fed speak this week. So the market will be looking at that, trying to read something, whether it's accurate or not. The market will try to interpret something to mean something. And more than likely in this market, they'll try their best to be bullish as we're trying to get, or the market's been trying to get to that all-time intraday high of 48.18. We did have the all-time closing high the other day. But the intraday high, I think the market's trying maybe the 48.20 area. I really think if we do get there, and I wouldn't be surprised if we do, maybe punch a little higher. But I figure at best, and I really at best, I think we'll go to 48.50. And then I think we're in for a pretty good pullback, probably see 4,700. I wouldn't be surprised if we saw all that happen this week, the 4,700, try to punch through, come back down. But we'll see. You remember many times we go down faster than we go up. And what do they say? Up the escalator and down the elevator. And that's what happens a lot. And I do expect that the market will definitely retrace at some point here. It could be now, or it could be after another attempt and maybe even making a new all-time high. But we'll see how that goes. So all that being true, let me share my screen here. And we'll see that the SPX, as I've been saying, of course, has been pounding at it, right? They're trying to get through 4,800, haven't been able to do it. And over here on the VIX, of course, we're just keep bottoming and bottoming. I really don't see us getting a whole lot lower, maybe getting the 11s. But man, I consider this VIX probably about as low or within a point or so as low as it's going to get, most likely. So you know what I like whenever we're down here. And of course, the SPX, as I just showed, is way up here. You know, I want to do a calendar, and I want to talk about those a little bit deeper today. So what I have here on the screen is a calendar. It's a call calendar. Generally speaking, you can do calls or puts in the SPX. It is cast settled. You'll never be assigned. And this one here is selling to 26, which is a week from this coming Friday, and then 4 days wide, buying the 30th. So let's take a look at something. First off, how's a calendar work in the first place? Well, a calendar's first concept of working, and I think really why they call it a time spread or a calendar, you hear both of those terms, is because the long that you buy, in this case the 30th, look at its theta decay. So at this point, when a day passes, the 47.80 call that we would have purchased in this particular setup is losing $1.50 a day. And by the way, the call right now is trading for mid 40s. And the call that we're selling to 26 is losing $1.73 a day. So the first thing you're looking for in a calendar is that spread. You're looking for that time decay difference. Your long is decaying slower than your short because, well, it's going to last a few more days. So since it has a little more life, it decays a little slower. So you're looking for that spread between the two, that differentiation. And that's one way you make money in a calendar. Matter of fact, that's enough right there to make money in a calendar. And if you look at this chart right here, this is actually telling you if volatilities in all options stayed the same, in the options you're in, that is, you would make this money just on the pure time decay. Just the time decay. You don't need volatility to work for you for a calendar to work. However, it can really work for you and consequently against you. I think a calendar is one of the most susceptible trades to volatility working for and against it that there is, much more than a fly, because in a fly, all of your options are in the same expiration. But in a calendar, you've got this long that's further out. And whenever you do that, you get a little more volatility or vega in your position. And if we look at the implied volatility of your long, right now it's at 8.87. And the one you're selling is at 9.27. Now, what you want is you want your long to keep or get even more volatility, more implied volatility, because implied volatility is part of an option's value. So obviously, if you sell an option, you'd like to see it lose its value if you want to buy it back cheaper, right? And if you buy an option, you want to see it keep its value or go higher, which is what we're after here. Remember, we can have these values stay the same and it's fine. But what we want to make our calendar, maybe we could get out even faster than time decay, would be if our long holds its value, its implied volatility better than the short. Maybe the short's going down more than the long is. You can see the VIX goes up or down. That doesn't always mean that your position, if the VIX is up, oh, my calendars are going to do great. Not necessarily. Or if the VIX is down, my calendars are going to lose. Not necessarily, because it's the position, it's the particular options that you're in. So we want this long to keep its value, its implied volatility rather, or higher, and we'd like to see the short lose it. So if the short would say lose a point of its volatility and the long would stay the same, then if you look right here on this position, see the Vega number of 5107, then you would make $51.07 that would show up in your P&L. Now, it's not realized unless you close the trade, but that's the concept. Every 1 point that the long would do better than the short is $51 to the good, so to speak. And if the short happened to go up more than the long by a point, you would lose $51. So that's something always to consider in what you're doing, which is why we want to do calendars in lower volatility. In fact, the lower the volatility, in my mind, the better calendars look, because you're going to have less and less of a chance of a volatility decline. And we don't mind, remember, if the volatility stays the same. We just don't want a big change in it where the short goes higher than the long. So let's go back over here and look at this risk profile. So in this example, I used the January 26th and I bought the 30th. Let's look at something here real quick. One more thing. You see, what do we have with the particular setup I like here? We have $23 in theta a day and $51 in Vega per point, and trade costs $4.85. But what if we did the 29th instead, which I like to do 3 days wide if the VIX is higher, say 15, 16. So if we did the 29th only 3 days wide, what do we get? $21 in theta, a little less, $38 in Vega, a little less, right? So we have less Vega exposure here, but we also make our money slower because the difference between the decay of the 29th and the 26th is smaller than the difference between the decay of the 30th and the 26th, of course. Even though it's one more day, it does matter. So that's why I like 4 days wide here. And also you go, well, you get that higher Vega. Yes, and I don't mind. I don't mind that the volatility exposure is higher, because I think chances are greater for volatility to go up in our favor than to go down. And indeed, we can take some down movement in the volatility. We just wouldn't want a lot. But that's why I like these here. That's why you, week after week, see me harping about these, because they've been working and because they work very well in a low volatility environment. And you know, I tell my students at SheridanMentoring.com, where you check us out over there, we teach options every day. I tell them that if the VIX stayed here forever, I might just do calendars forever. I might not be doing many flies or I might do some diagonals, calendars, and maybe a fly once in a while. But if we're down here this low, I'd rather do calendars because they work, I think, better in this environment. Now, when you get this VIX up 14, 15, I think the fly starts to shine a little brighter than the calendar, most likely. But I still think there's a use for one, kind of a time when you might want to mix both in. But I think in this case, I'll just play this. I'll play calendars until the environment isn't right for them anymore. And over my years of trading, I've seen this go on for a year before, maybe even more, where calendars, they were just it. They just worked and worked and worked. And what really helped calendars is whenever we went from just having a monthly expiration, when I got into this, you sold one month and bought another. You didn't have weeklies in between. And then when weeklies came along and they got liquid, that made calendars much more nimble. You could dial in your volatility exposure better, like we're doing here. You know, it used to be, even if you just had Friday weeklies, you'd always have to be 7 days wide. Sometimes it'd be better to be less. And in this environment, it's good to be able to just kind of hone that in. What do I like? 3 days, 4 days, 5 days, maybe 7 days. If we get much down in the 10s and 11s, I'll probably be doing 5s and 7 days. There's nothing wrong with it. I'm not saying a 7-day wouldn't work now, but I think you can get a pretty good exposure without the extra expense of being 7 days wide by being 4 days wide here. So this is what I would do for here. I most likely would put this on a little below where we're trading, wherever that is. When we get into Tuesday, what I think would be ideal is if we did go up some, and then maybe towards the end of the day, don't do this right off the bat. Wait till later in the day, Tuesday. And if volatility is still down in here, and maybe we went higher, that'd be terrific. If we went to 48, 20 or 30 or something, I would love putting this on, because I really think at that point we'll slow down, pause, maybe even come back a little. So put this on a little bit below, so your peak's a little below, gives you a little more short deltas in many instances. So, and it just helps you out because you have more room to the downside. Volatility would probably rise, probably boost your calendar, and I think we'll be in good shape here. So that's what I like here. Try to get 8 or 10% of whatever you pay for this. And have a great week trading. I'll be back here next Sunday with you again to review what's going on by then. Maybe we'll have a totally different market. Maybe volatility will have spiked and things are different. We're back into the flies, but we'll see. Have a great one, everybody. And as always, I appreciate you subscribing to my videos. We're just about to go over 1,000 subscribers. I really appreciate that. And please tell your friends, hit me with those comments. I do answer those. I really appreciate them. And let me know. And if you like me diving into how a calendar works and how trades work, that's not something I've done a lot of. If you'd like me to just talk about why a fly works or calendars work like I've been doing here or other trades, just let me know in the comments. Happy to do that. And I'll talk with you guys next week. Have a great one. Bye-bye.